Hello, I'm Jim Lebenthal, the Chief Equity Strategist at Strategist Partners and a member of our investment office. And this is our outlook on the economy and financial markets for the month of November 2025. It feels like all year we've been telling you good things about the markets. Yes, there was a little bit of a scary moment in April, but for the most part, this has been a very positive year throughout the financial markets. We've seen equity markets of all flavors doing very well, whether it's US, international, large cap stocks, small cap stocks, value stocks, growth stocks. All flavors of equities have been doing well. The same can be said in the fixed income market, where whether it's treasuries, municipal bonds, high yield bonds, all flavors of bonds have been doing well. Similarly, in the commodities markets, where we see strong price action from industrial metals like copper, and especially precious metals like gold. And maybe gold is a good stepping off point to what I want to talk to you about today, which is risk. Because many people look at gold, and certainly this year's rally reflects its place as a measure of risk, a safe haven when people think that things are getting too frothy. And we're getting a lot of feedback from clients and from colleagues questioning the strength of this rally and how can it possibly continue to go up with all the risks that are out there. We acknowledge the risks, which I want to go through in a second, but we also acknowledge that the risks in and of themselves have not been and don't appear enough right now to derail the rally, which we think will continue into year end. But those risks include corporate credit quality, which we've seen some questions about with the recent bankruptcies of automobile firms Tricolor and First Brands, as well as questions about the artificial intelligence trade and whether the internecine relationship between companies like Oracle, OpenAI, and NVIDIA may be high to faltering demand for the underlying artificial intelligence products. We also acknowledge the risks in the government shutdown, which continues and is now the second longest in history, as well as continuing geopolitical risks, threats to the Federal Reserve Bank's independence, and continuing trade policy uncertainty around tariffs. But as we put this all together, we remind you that the backdrop is very positive. The economy continues to grow here in the US at well above 3% annual rate. Inflation is, while not down at the Federal Reserve's target of 2%, not that far off at just under 3%. And the labor market, while not perfect, still retains strength. All this gives us optimism that the markets can continue to rally into year end. Combine that with the absence of selling pressure in the financial markets where people are unlikely to want to take capital gains this late in the year if they're taxable investors, as well as professional money managers who don't want to take the risk by selling that they'll fall behind their benchmarks. And on that note, it's worth pointing out that only 25% of active managers are beating their benchmarks, which means that any dip in the financial markets are likely to be bought by those 75% of active managers who are trailing their benchmark and facing a desperate need to catch up by throwing money at the markets. Now, I know I'm only talking about the next 2.5 months, and we'll update you along the way. But our thoughts are that we should crescendo into year end, and we'll keep you posted over the next 2 months as we reach that year end. Thank you as always for listening. I look forward to our next update with you.